Is the worst really over for inflation, as the good finance secretary believes?
Yes, I agree. I agree with the good secretary. And this is brought about by two factors. Basically, one is the decreasing price of oil in the international market. And second, we've seen the GDP numbers, and therefore our economy continues to recover, and that will address the supply side of our inflation. So there will be a reduction in the cost push side of our inflation, and therefore our only concern will be primarily be about the demand pull inflation. So therefore this is, in a way, this is a good problem somehow, because we will just be addressing a problem inflation that is caused by an economy that is continuously growing.
But will not second round effects push, at least provide some upside pressure here in the second half of the year?
Yes, so that will be continually be monitored, I suppose, by our fiscal and monetary authorities, and therefore, but somehow this will provide all of us, no, some semblance of an ability to forecast the future over the next 4 quarters, and therefore that will signal a lot of confidence for our investors, both foreigners and domestic investors, and that's very important because our concern, our bigger concern is a supply side one. No? So from the side of agriculture, side of manufacturing, side of trade capacity, infrastructure capacity. So we can focus now on these supply side problems, increasing our agricultural productivity, increasing our manufacturing productivity, continuing our infrastructure, so that we continually feed the demand of our growing economy. So I think that's a more important long-term problem for all of us.
Okay, so you subscribe to the notion that inflation has peaked in June at 6.4%. What then for you will be the trajectory moving forward for the latter half of 2022?
So it will be, I think, no. So it will still be above 5%, but I agree. But towards the last 3 months of this particular year, we will be experiencing a reduction in inflation, and therefore, for the following year, 2023, we can see that inflation will be now going towards the band of the 2 to 4%, which is healthy for our economy. So these are all good signs, provided that tensions at the international level will not escalate. So at the rate that we are seeing right now in relation to what's happening around us and what's happening outside the Philippines, kung hindi na yan lumala, no? So these things will not escalate. So we can expect that our economy will continue to perform way better than expected.
All right, not in any way helping, of course, our sugar prices. I mean, that has been soaring to new heights, and now you have the president rejecting the importation of 300,000 metric tons of the commodity. From an economist's point of view, what do you make of that move, and how might that impact prices moving forward?
Well, I'm imagining that the president is trying to help our farmers, our sugar farmers, because this is now the harvest season. And so if we are able to help our farmers with the purchases of their harvest, then I think that will, in a way, provide additional purchasing power to our farmers, and then that will encourage more production for our sugar. And perhaps our government is already betting that these additional harvests will be able to substitute for these imports, plus the increasing the purchasing power of our farmers, which will then fuel the additional production on the agriculture side, which from the GDP numbers, we only grew our agriculture by 0.2%. So that will, in a way, both help the production and at the same time our total GDP, which is being contributed now by the farmers, hopefully for the next 2 quarters of our GDP.
But are you really optimistic that local production would really be meeting immediate needs here, immediate demand for sugar? I mean, the president, from the get-go, his rhetoric at least, has always been towards more boosting local production rather than importation. I mean, is that going to be the right trajectory here, especially considering that we have a near-term need here at the moment? Isn't that going to be more of a long-term policy here when it comes to being more focused on domestic production rather than importation?
Well, that's an executive decision and an executive bet on his side. But if we take a look at it from the point of view of basic law of supply, an elevated price though a concern from the side of inflation, but will be an incentive for our sugar farmers to actually produce more. So higher prices means higher production. And we need it from our agriculture, since our agriculture, though 9% of our total economy, accounts for almost 50% of our total economy, if you take a look at the whole agribusiness perspective. So you really want to boost the productivity of the agriculture, not being dependent on imports. And so our president, I only imagine, is really betting on our farmers and taking advantage of this high price environment to make sure that they are able to produce more, and they are able to convert these high prices to higher productivity as our government programs are being developed to make these productivity more long-term in terms of technology, in terms of digitalization, in terms of e-commerce. But before all these programs be rolled out, I think the high price of sugar may be able to immediately address their productivity over the next 5 months.
Okay, now again, of course, the slowdown that we experienced in second quarter growth was blamed primarily on high inflationary environment, as you mentioned earlier, expecting that to ease up at least in the latter part of the year. What then does that say about the growth prospects for the rest of 2022? Do you see us hitting government target of 6.5 to 7.5%?
Yes, I think it's not a real problem of a slowdown, because we really performed at a higher than average growth rate over the last 10 years. So more than 7% is still very high from all standards, and therefore hitting the 6.5 to 7.5 is very, very easy. In fact, I think 7 at this particular point is already very achievable. Okay. Having an 8.2%, a 7.4, and then we traditionally have a fourth quarter, which is our bear months. So our big celebration for our Christmas season. So fourth quarter is traditionally very high or higher than the traditional other quarters. So therefore, 7% at this particular point is very achievable, and 7.5 and don't be surprised if we hit our GDP by 8% towards the whole year of our GDP, if this particular price environment continues to decrease or even be supportive of our economic growth. So 7, 8 may be a unexpected surprise for all of us at this particular point.